Relief from inheritance tax can be available on assets that qualify for Business Property Relief or BPR. Qualifying assets include shares in unquoted trading companies, interests in trading partnerships and sole trader businesses. For relief to be available, the business must be wholly or mainly trading, meaning that if there are significant non-trading assets, for example investments, investment property or surplus cash, relief could be denied. Before the 5th of April 2026, BPR was unlimited, meaning a full exemption from tax was available on qualifying assets. The BPR rules changed from the 6th of April 2026, and now only the first £2.5 million of qualifying assets per individual are exempt from IHT. Anything over that threshold is taxable at an effective rate of 20%. The £2.5 million threshold is per individual, and any unused amount can be transferred between spouses on death. The threshold is a combined value for both business and agricultural property relief. These rules mean that any individuals who have qualifying business interests with a value of more than £2.5 million will have a potential inheritance tax exposure on their business assets. So what do these rules mean in practice? If you own a business that is worth £2 million, assuming you have no other qualifying assets, the full value would be covered by the £2.5 million threshold, and so no IHT would be payable on these assets on your death. If the business increases in value during your lifetime, this may not be the case on your death. Also, if you plan to sell the business before your death, the assets that qualify for relief today would not qualify once there is a binding contract for sale. So even if you have no inheritance tax liability today, this does not mean that you should not think about the future and potential tax planning opportunities that are available to you. If you have a business worth £4 million, you could have an inheritance tax liability of £300,000, which is 20% of the value over £2.5 million. If you could have an IHT liability on your business asset, a key consideration will be how this could be funded after your death. If you own qualifying business assets, what should you be thinking about now? First, it's important to understand whether you do have a potential liability. As I mentioned earlier, even if you don't have a potential liability today, that does not mean you should not consider planning opportunities that could prevent a future liability. Once you understand your current position, you can consider what steps you might want to take to mitigate the potential liability. Depending on your circumstances, this could involve transferring assets to your spouse, giving shares away to future generations, or transferring assets into trust. You should also review your will to ensure that the £2.5 million allowance can be used effectively and allows for post-death tax planning.